Founded in 1983, the Silicon Valley Bank specialized in banking for tech startups. It provided financing for almost half of U.S. venture-backed technology and healthcare companies, while relatively unknown outside of Silicon Valley. The Silicon Valley Bank was among the top 20 American commercial banks, with $209 billion in total assets at the end of last year. According to the FDIC, the bank held deposits from companies such as Roblox, Circle, BlockFi, among others. This fall is expected to have some ripple effects in the long run. November 2022, J.P. Morgan warns the Silicon Valley Bank. J.P. Morgan released its now troubling research that warned that the balance of deposit outflows and inflows should not persist longer than expected, and that with the risk, the Silicon Valley Bank would need to sell their held-to-maturity securities and realize losses. Hence, the focus of investors rapidly shifted to the company's $16 billion unrealized losses in its HTM securities portfolio. Even after recording unrealized losses, J.P. Morgan's analysts were largely optimistic about the Californian-based bank and even stated their stock's value would increase. The research showed the looming disaster, but with the internal corporate kiss-ups that exist between analysts and businesses that forces sell-side analysts to put a positive spin on the Silicon Valley Bank as to remain in the company's good graces. Why, you may ask? This is due to the ungodly pressure on research analysts at large banks to sweet-talk corporations. This has been a problem for at least 40 years, notwithstanding some window dressing regulations that were adopted almost 20 years ago. Such factors led to the cover-up. Although the Silicon Valley Bank knew they had serious risk management issues, which they chose to cover the findings up. The Silicon Valley Bank ran like a bad gambler. A good gambler would at least know the risk-to-reward calculation of their position. The Silicon Valley Bank took a position that had a much bigger downside, such as the risk of bankruptcy, than upside. All that had to happen was a rise in interest rates for their position to be underwater. February 27, 2023, Greg Becker, the CEO of Silicon Valley Bank, sold $3.6 million worth of company stock less than 2 weeks before the firm revealed the extent of its losses. Becker unloaded 12,451 shares at $287 each. This was the first time in more than a year that the CEO sold shares of parent company of the financial group, according to regulatory filings. Signaling bank officials might have known the bank was in trouble, though there is nothing illegal about corporate trading plans like the one Becker used. The plans were set up by the Securities and Exchange Commission in the year 2000 to thwart the possibility of insider trading. The idea is to avoid malfeasance by limiting sales to predetermined dates on which an executive can sell shares, and the timing could merely have been coincidental. However, let's understand that the prearranged share sale plans, called 10b-51 plans, have significant loopholes, including that they lack mandatory cooling-off periods. In December, the SEC has dealt with this and has finalized new rules that would mandate at least a 90-day cooling-off period for most executive trading plans, meaning that they can't make trades on a new schedule for 3 months after they take hold. Executives are required to start complying with those rules on April 1st. Wednesday, 8 March, 2023. Unrealized losses are quickly realized. The Silicon Valley Bank sold $21 billion worth of bond assets at a loss of $1.8 billion. The bank also announced that it was conducting a capital raise and would sell $2.25 billion in new shares to shore up its balance sheet. Despite this, the bank witnessed a wave of withdrawals as key venture capital firms advised companies to withdraw their money from the bank. Further, crypto-based lender Silvergate's announcement on Wednesday of a plan to wind down operations and facilitate liquidation owing to heavy losses following the collapse of crypto exchange FTXDX led to increased withdrawals from the Silicon Valley Bank. Thursday, 9th March, 2020. The Silicon Valley Bank crash. The Silicon Valley Bank stocks went in a downward spiral, crashing over 60%. Regulatory filing at the end of business day showed that the Silicon Valley Bank had a negative cash balance of $958 million. The filing also said that despite the bank being in sound financial condition prior to March 9th, investors and depositors reacted by withdrawing $42 billion of deposits, causing the classic and dreaded run on the bank. Friday morning, trading in the Silicon Valley Bank shares was halted, and it had abandoned efforts to quickly raise capital or find a buyer. California regulators intervened, shutting the bank down and placing it in receivership under the Federal Deposit Insurance Corporation. What's next for the Silicon Valley Bank? So, while a broader contagion is unlikely, smaller banks that are disproportionately tied to cash-strapped industries like tech and crypto may be in for a rough ride. Wall Street knew that the Fed's rate hiking campaign would eventually break something, and right now that it's taken down small banks. Most likely, the Silicon Valley Bank will be cannibalized by other banks to find enough money to pay back depositors. Conclusion: the Silicon Valley Bank had $16 billion in unrealized losses, which showed the bank was not running as a bank, rather as a gambler, which is sad since your money and my money is usually used to make risky gambles by banks, and the board of directors are rarely affected by the banks, and the board of directors are rarely affected by the consequences of their actions. Thank you for watching and kindly subscribe for future videos.